So this part is clear to you? Financial condition after 1 year. Now what I want you to do is, I want you to go to the initial discussions and start looking at the cash flow numbers, yourself. Now, why I want you to do this is simple. I mean, I will obviously explain it side by side, but the more you do it in your own pen and paper, you'll be able to relate to the whole idea. Now, what is cash flow from operations in this particular case? Okay, let me do one thing. Let me skip cash flow from operations. Why to do the difficult things, right? Let's do the easy part first. What is my cash flow from financing activity? Sorry, investing activity. Did I take any money this year? Did I raise any capital? Well, not. Right? So this particular year I didn't raise any money. So my financing activity is 0. Right? But did I repay something? Well, I didn't repay any debt for sure. Did I repay anything else? Well, I paid some interest, right? So interest is, why am I paying the interest? Because I have taken some kind of loan from somebody. So since I have a financing activity done throughout this, in my business as of now, which is debt capital, my interest paid is going to be a reason. I mean, why am I paying the interest? The cause of this particular activity is my action of taking loan. Since my action of taking loan is a financing activity, the cause is also going to be a, financing activity. It's a financing activity. The cause is also going to be a financing activity. All right. So my 50,000 interest is going to go into the financing activity. All right. Now, cash flow from investing in this particular year, have I made any investment? I didn't buy any particular asset. I didn't buy any particular, I didn't invest money anywhere else. So in this particular year, my cash flow from investing is also going to be 0. Right. So interest paid is 50,000. Now interest paid is going to be negative or positive? First question. Well, that's a negative cash flow item. Why negative? Because I have to take the money from my vault and give it to somebody. So if you keep on thinking it from the vault's perspective, you will get the idea whether it's a negative cash flow activity or a positive cash flow activity. All right. So in this case, my interest paid is going to be minus 50,000, not plus 50,000. Now let's go to cash flow from operating activity. Now I'll do one thing, rather than taking you to the slide, just let's think amongst ourselves what is the cash flow from operating activity in this particular year. So if you have a pen and paper, just start writing. In this particular year, you made 1.25 in terms of revenues, right? Then you had 3.6 as an expense for your employees. All right. Then you had 50,000 as an expense to miscellaneous activities. Okay. All right. Then you had 50,000 rupees worth of inventory which you used in this particular year. Now, the question is, my question to you is whether that 50,000 rupees of inventory is going to come in this particular year or not. Will come, yes, yes. Well, if you are comparing it with the starting of your operations, it was accounted last year. Okay, that's exactly what I'm coming from. So if I'm taking from the very starting of my business, it will come because that activity of buying the inventory also happened in this particular year only, first year only, right? If I'm comparing it with the first 5 days, well, in that case, my balance, this particular year, if I'm starting from 5 days point to this year, well, that will not come. But if I'm starting from my day 0, when I actually got my capital, well, this is in this particular year only I have taken some inventory of 50,000 rupees. All right. So whether that has changed, whether the inventory number is changed or not, it doesn't matter. If I just think from operating activity perspective, from the day 0, from the starting of my company, I have used 50,000 rupees of worth of raw material. All right. So that is again going to come here. All right. Now, since it is going to come here, I'm going to have another minus 0.5. Okay. So what is the number now? What does the number become? It is 1.25 minus 3.6 minus 0.5, another minus 0.5. And there is one more thing which is there, right? Which was depreciation. Should the depreciation come here in the operating activity? Well, depreciation will not come here. Why will not come here? Because again, think about it. In this particular year, to get those 1 lakh rupees of assets, all right, I am not taking the money out of vault and paying for it. It is non-cash expense, as somebody wrote here. Exactly. All right, so a non-cash expense is not going to come in my cash flow from operating activity. All right, so I do all these things. My cash flow from operating activity will come as minus 2.85. Now, why I didn't go about doing the bookish formula is because if you understand the basic, what we did in this particular case is that we derived cash flow from operating activity. Yes, no money out of the world. So when we calculated the cash flow from operating activity, we started from the net income number, the revenue number. All right. So there is a way to derive cash flow from operations if we start from the revenue number. But generally, Jatin, I'll just do the calculation for you, okay? But generally what happens is that in the formulas which we see in the books and actual annual reports, the starting number is generally not revenue. The starting number is either PBT or it is PAT or it is EBITDA, but it is generally generally it is taken to be, the starting is not revenue. But I want you to see that from the revenue also you can derive the cash flow from operations number. But now let me do it the bookish way. The bookish way is to start with the PAT number or EBITDA number or whatever the number we want to use. Let me use the operating income number, which is the EBITDA number. Now if I start from operating income number, okay, in this particular activity, there is only one thing which I have to add, and my operating activity minus 3.35 includes a raw material expense. All right, but my raw material expense is not coming from my P&L directly, it is coming from my storeroom, which is the inventory. Okay, so what I do is I take the change in inventory, because change in inventory essentially tells me how much money is coming. No audio. Is the audio not coming? I'm sorry, I didn't realize that. You can hear. All right. Somebody has to check. I mean, why it's not coming. All right. So in this particular case, my inventory is, the change in inventory is actually sponsoring, if I have to say the word. It is sponsoring my raw material purchases. Okay, my raw materials are coming from my inventory. Okay, so if I'm looking for cash flow from operations, what I do is I look in my balance sheet and I see, okay, what is my change in the inventory? Since the inventory is changing, cash is not going to go from my vault. I'm just using the raw material which was there in my storeroom. Okay, so what I do is I take change in inventory and I add back that number to my operating income to derive the cash flow number. Is this point clear what I'm doing here? Why am I taking change in inventory? What I'm doing here is I'm saying, okay, cash is not going out now in this from 1 year to next year. What I do is I look at inventory last year and inventory this year. I'm now talking generally, okay? When I look at two inventories number, if the inventory is decreasing, that means not all of my raw material was actually gone. I didn't go to market to purchase my raw material. I just went to my store and I took the inventory and I started making the stuff. Okay. Now since the inventory was lying there, the actual cash flow is not going out of the particular vault. Right. So this is the reason generally we start with operating incomes and we do something called changes in working capital and we add back that number to cash flow from operations. The moment we do that, we come up to the actual cash flow from operations number in the actual statement which you will see in the actual annual reports. Okay, so again, the moment we go forward, this will become far more clear, but I just wanted to put the formula in the context which you guys will generally see in the books. All right. If only 20K used in inventory, then change in inventory will be 20K exactly. So if I use only 20K, I'll take only 20K. Absolutely right here. Okay, I'll do one thing, Vishwa. It's a very good point, and let me explain this here only. So let's assume that in this particular year, you actually, the 50,000 rupees of inventory was not used. Only 20,000 you used from inventory, and 30,000 you actually went to the market and you got the amount. All right. So in that case, your operating income, which is minus 3.35, out of this only 20,000 rupees is coming from your storeroom. Rest for everything else you spend the cash. Alright, so then in that case, out of minus 3.35, minus 3.15 is what is actually your cash flow. On the other hand, 20,000 came from your inventory. Okay, so that way, whatever you are going to use, that only is going to come in your cash flow numbers. Very good point, Vishwa. Thank you. Is this point clear to everybody? We'll move forward only when this is clear, because that is the key point I'm trying to cover. Shini, okay, I'll discuss this thing later. I mean, slightly more technical, but yeah, if you do it after the financial year, yes, yeah, you are going to take it only in the next year, not in this year. Is it clear? Can we move forward? Great, great. So if you get this point, I mean, we'll do few more things, but after that, whatever annual report you pick up and you read the financial statement, this will be pretty clear to you. Okay, so let me just move forward and let's see this number. All right. Now what we did is we derived the cash flow from operations, which was, and we derived cash flow from financing and investing activity. This total cash flow number gives me the change in the particular year. All right. It gives me the change which has happened in this particular year. So what I do is, if I add this change in this particular year, change of cash flow, in the starting cash flow of my balance sheet, what I should get is the ending cash flow of my balance sheet. Okay. So when we were doing the balance sheet and we made the application of funds, we started with the 9 crore rupees of cash, and we added and subtracted all the activities, and we came up with the final number of the balance sheet. Now, if I don't do that, generally the companies don't go and sit about, starting from, okay, this was my initial cash, then I go, while making the balance sheet. What they do is, they make the cash flow statement, whatever cash changes happened in this particular year, they will take that last number and they will add it to the last year cash number. So this way they derive the cash in the balance sheet. Alright, now, when they actually go and check the physical cash and they see, okay, the cash should match. Obviously the cash should match in that case. But my idea here is how the cash flow statement is interacting with the balance sheet. In the balance sheet, all the things will keep on changing in the application of fund side. Cash will also keep on changing on the application of fund side. And how the cash is going to interact, all the cash changes which are going to happen are going to show, you're going to show them in cash flow statement. And the last number, which is the total change in the year, you're going to add back to your balance sheet number. So in this case, minus 3.35 is the number I have derived from my cash flow statement. If I go and add this number to starting cash, which was 9.9 lakh rupees, I'm going to get the closing cash of 5.65 crore rupees. Sorry, again, it's lakhs, I'm sorry. But yeah, the idea here is that you will get this 5.65 number, which is the same number which you also derived in the balance sheet when we were doing the application of funds. So you derive it that way or you derive it this way, the number should be absolutely same, is the point I'm trying to make. Alright, let's move forward. Now I want you to take some assumptions. In fact, we will take a 5 minutes pause here for a simple reason. I will give you some assumption and I want you to think on what is going to be the next particular year going to look like. So let me just take you through the assumption what happens in the next year. Okay. Next year, this thing happened. First, you got a major order from a company and they gave you a year-round contract. Okay. Also, if you have pen and papers with you, just make a note that this contract is of 2,000 ice creams per month. Okay, 2,000 ice creams per month. Then the word of mouth spreads and your joint now becomes very popular. Okay, so now you have a very popular shop and you start selling a lot more of ice creams. Now since you are big, earlier you used to go to the market, you get your raw material stuff and you keep it in the store. Okay, what you do now is that you get your stuff from the market, but you don't pay the market instantly. You tell your suppliers, because now you're big, what you do is you take the stuff first and you pay them later. All right, and this is what generally we call the credit period. Okay, so I go to the market, since I'm sourcing in bulk. What I do is I'll pay after some time. All right. Now let's assume this credit period to be 60 days. So you are going to pay the suppliers 60 days later than your actual purchase. But then, since you can do it to your suppliers, somebody can do it to you also. So the company which gave you the order, that company is going to tell you, "Ki boss, I will pay you only after 1 month of your actual delivery of the ice cream which you are going to do here." Okay, so you are on the receiving end this time. What they are going to say is, "Okay, I'll pay you after some time." But the time period they decide is 30 days, let's assume. Okay, so they pay you after 1 month of purchase. Then another thing which you decide is that last year, you know what happened? We started with 50,000 rupees of inventory, and we kept on using that inventory without making the purchase from the market. And at the end of the year, we were lucky that, you know, everything we had in the store was used, but we don't need more than that. But when you're running a bigger business, you cannot afford to keep on using stuff from the inventory and without refurnishing the inventory, if I have to say that. Why? Because in a bigger business, your demands keep on changing on a daily basis. It's not very consistent. So what you do is you decide to keep some inventory permanently. You want to keep that inventory number to 5,000 units of ice cream. So inventory should be such that you can easily support manufacture of 5,000 units of ice cream. And that number should always be maintained in your storeroom. Whenever you go in the storeroom, you should have 5,000 ice cream worth of raw material in your inventory. Then, since it looks like it's a great year for you, what you do is you decide to pay some part of your loan. Okay, so let's assume 1 lakh. You said, okay, this year you have made some money, you will pay 1 lakh rupees of loan. And it has been such a great year. I mean, it's obvious from the numbers as of now. It is such a great year. You also decide to put some spare money which you have left in a mutual fund. Let's assume you make an investment of 1 lakh rupees. All right. So these are the assumptions. As I told you, you're going to sell 2,000 ice creams to the company. Okay. And another assumption is that you're selling 5,000 ice creams this time per month, not per day, per year, which you did last year. You sell 5,000 ice creams per month. Okay, so out of which 3,000 goes to the normal people who come to your shop and they eat, and 2,000 goes to that particular company which has given you an order, long-term order. All right. Now what I want you to do is, I want you to imagine that, you know, this year is ended. I want you to take that paper out and think that, okay, now I have to make the ledger for this particular year. How will this year looks on that paper? Okay, so just write all the things which you did last year. The revenues, the expenses, whatever interest you paid, all those things. Just take 2 minutes, just think about it, and then we'll resume this. All right, so have you done the calculations now? It's like a cool breeze in the turnaround. Yeah. Right. All right, so let's start looking at what happened next year. All right, so first question, what is going to be your revenue? ₹15 lakh, right? 15 lakh rupees. So 5,000 ice creams you sold, revenue is going to be 25 rupees into 12 months into 50,000 for 5,000, which is 15 lakh rupees. So perfect. Yes, revenue is 15 lakh rupees. Now let's go to the expenses part. Now somebody asked me, all the assumptions are same, right? Even if you assume the same things, that doesn't matter. What is the number of ice creams sold at the counter? We have sold 3,000 ice creams from the counter, and 2,000 to the companies. So every month 5,000 ice creams, 3,000 is to counter sales and 2,000 is through company sales. Alright, so let's go through the expenditure. Now raw material cost is 60,000 units into 8 rupees. Now why I have taken 8 rupees is to make you realize the simple concept which what we call as the economies of scale. As and when the companies usually go about expanding their scales, what happens is that the cost of sourcing, because they source in bulk, the cost of sourcing keeps on decreasing. So generally what happens is that in bigger companies you will always see some kind of a what we call economies of scale. Now there is a big argument that whether an economies of scale is so-called the concept of moat. Is it a moat or not? Now unless and until you are too big to make it as a meaningful impact, then it is a moat for you. But generally on a scale of 20-30% higher number of revenues than the other person, well, it's not that big a moat. And nowadays even smaller people are able to really do a lot of negotiations, which was earlier not the case. But nowadays unless and until we are too very big, then it doesn't really, unless until that is the case, it's not really a big moat for you. Now yes, otherwise it would have been you're right, it would have been 6 lakh rupees, but this time it is only 4,80,000 rupees. Okay, now last year was a bad year for you. When you have a bad year, do you get a hike? No, not really. Alright, so in this particular year your employee cost is same, and the other miscellaneous expenses go slightly higher. In fact, it goes double this year. Why? Because again you have more electricity use because of ice creams. It could be more home deliveries. You also have to bear the packaging cost of delivering it to the company. Whatever that number is, you have some other miscellaneous expenses, and the number goes to 1 lakh rupees. Now can you quickly tell me what is the operating profit or any other expense we have done in the operating part of it, in the operations? There is no other operation expense. Alright, so quickly tell me the operating income. Absolutely right. 5.6 lakhs. Good point. 20,000. What is 20,000? Okay, so the operating profit is 5.6 lakh. Okay, Vishwa, I'll tell you the inventory part. But as of now, in this particular, so when you're taking the raw material, you're only going to take the raw material cost which is used to make the products. If you're buying, more than what is required and you're storing it in your storeroom, that is not going to be a part of your raw material cost. Alright, so in the P&L statements, the only thing which you make is, the only thing which you take is what is the cost which you have borne to make the revenues that particular year. Alright, so in that case, your cost, your total operating profits become 5.6 lakhs. Now let's go to other expenses. All other expenses are more or less same, right? The depreciation is same because for next 5 years, the depreciation amount is going to be absolutely same unless you really go and buy another asset which increase the value. But as of now, you don't need it. Your operating income is 5.6 lakhs. Your depreciation is 1.1 lakhs. Interest cost, as you notice, is 50,000 rupees. Now, no matter you are making 5,000 ice creams a month or a year, the interest cost, the bank cost is going to remain absolutely same. And that is one big reason why debt is preferred as a way of raising capital when it comes to, in profitable ventures. Alright. Now profit before tax in this case is going to be 4 lakh rupees. This year you have to pay some taxes. Alright. Now again, if you go to technicality, okay, Nitin, you're right, we have paid 1 lakh rupees, but I'm assuming that the payment is done at the end of this year, not in the starting of the year. Okay, so all those things which I told you were the assumption for the complete year, not at the starting of the year. Okay, so in this particular year, when you started, you had the loan of 5 lakh rupees only. Only at the end of the year, when you have made the profits and everything else, then you decide to pay off your debt. Alright, so assume this payment is done on the last date of the year, not the first day of the year. Okay, now another question which generally usually comes up is why not you have taken the benefit of losses, and that's for the sake of simplicity. So I'm assuming 30% tax on the profit before tax, but generally in the practice, if you have made losses last year, you get some kind of a benefit for this year, which is you carry the losses on the books and the number is lower, but just for the sake of simplicity, I'm assuming that the number is same. Alright, so in this case the tax goes to 30% and the PAT is 2.8 lakh rupees, which is the profit after I have given the taxes. So now the terms should be pretty clear. Operating profit is the EBITDA. 4 lakh rupees which should write is PBT, which is profit before tax, and PAT is what we call profit after tax. So in this year, at the end of 2 years, when I'm sitting and I'm making the accounts, I have 2.8 lakh rupees worth of profit which I have made this year. Alright. So what happens then? Now I want you guys to make this application of funds and sources of funds yourself. It's pretty simple now. So first of all, let me go to the application of funds part. Okay, forget the sources of funds right now. Let's go to the application of funds. What happened to my net block, which was the fixed assets? What will be the value now? Quick answers. 3.3, absolutely right. So my fixed assets in the starting of the year, they were 4.4 lakhs. 1.1 lakhs is the depreciation for this year. So 3.3 lakhs is going to be my net block this particular year. Now remember, when you're actually looking the same thing in the actual balance sheet, you will see a gross block of 5.5 lakh rupees and the accumulated depreciation of 2.2 lakhs. So what does accumulated means? All till this year, till the moment, because balance sheet is a snapshot, till this point, how much total depreciation I've already taken on this particular asset. So if you do it that way also, you'll derive the same number, which is 5.5 minus 2.2. Okay, so in this case, the number will be 3.3 lakh rupees. Okay, now what happens to my inventory? What was the starting value? Starting value was 0 rupees. Okay, we started the year, we had nothing left in our store. We used everything. But this year we decided to have 5,000 worth units, enough to make 5,000 ice creams in the storeroom. How much I need to put in inventory in that case? Is it 50,000? $40,000 exactly. So it is going to be 40,000. Why? Because our cost is now 8 rupees per unit. To make 5,000 units, I need 8 rupees worth of per unit inventory. Okay, so in that case, it is 40,000 rupees. Then we have also done an investment. Now investment is also going to be a future profit. So investments generally go in your assets as non-current assets. Now there is a possibility that you can do an investment for short term also. In that case, it goes in your current assets. Okay, so as of now, I'm treating it as a long-term asset, but it can be taken as a short-term asset also. 1 lakh rupees. Okay, now I want you to come at the other numbers. First thing, there's another asset which is now going to be created, is the receivable. Now, what happened here is that you made 15 lakh rupees worth of sale. Okay, but the last sale which you made in the month of March of 5,000 units, out of those 5,000 units, 2,000 units were given to that particular company. The company has still not paid you anything, but it is going to pay you, right? So if the benefit is going to come to me, and it is going to come this year, because the company is going to pay me only in 1 month. Now when that is the case, I will receive 2,000 worth of ice cream amount from this company in this particular year. That we generally take as trade receivables, or what we generally call as debtors or sundry debtors, or whatever the amount, whatever the name you want to use for that. All right. Now trade receivables, sundry debtors are the general terms used. What will be the amount? 2,000 ice cream for 25 rupees. So the amount is going to be absolutely right. Absolutely right. So it is 50,000, right? But also remember that you have taken the complete expenses in your P&L account. But when you actually source the raw materials, the supplier has still not got the payment for the month of March and February, which are the last 2 months for which you bought the supplies. Now since you have to pay them and you have not yet paid them and you will pay them in the next coming 2 months, that number becomes a liability for you because you have to pay it. And since you have to pay it in this particular year, it is something becomes a current liability. Okay, this is also something we call trade payables or payables. Alright, now since that is the case, what will that number be? 8 rupees worth of ice creams into how many units of ice cream you are making? 5,000. So 5,000 into 2 into 8 rupees, which becomes 80,000 rupees. Exactly, perfect. Manish, why 40,000? Why 60,000? It's 2 months worth of supplies you have not paid for. Alright. So 2 months supplies, 8 rupees per unit, and 5,000 units per month. Alright. So the amount becomes 80,000 rupees. Now I'll answer all those questions which you asked me initially. Alright, the working capital questions. So this current assets is small term in nature. So I have these assets which I'm going to get in the small term. And in the small term, I have to pay 80,000 rupees. Now, if I have small term assets of 90,000 rupees, which is the case here, even if my business goes to a toss, okay, it goes for a toss today, what will happen is that I can sell my inventory and I can take the money from my, my receivables, and then I can pay my suppliers and I will still have some money remaining. Okay. This concept is called a positive working capital. What that essentially means is that I have enough current assets to meet my current liabilities. So even if everything goes for a toss, I am still not going to be declared bankrupt. Okay, I can pay off my suppliers, and bankruptcy happens when you cannot pay off your suppliers. Alright, so I can pay off. I mean, forget the debtor part and forget the long-term loan and all this stuff. I'm just giving you from a short-term perspective. Alright, now in this case, the second question, generally we look for companies which are negative working capital. So there are two discrepancies here. For people who have already studied this in their colleges, generally they say that we should have a very, very good ratio of current assets to current liabilities. That means there should be enough current assets to pay off your current liabilities. And then we hear terms like company should be negative working capital. But if it is negative working capital, that means current assets are less than current liabilities. What is working capital? Current assets minus current liabilities. Okay, so how can both the things be good? That is one question, right? Now, actually, from a perspective of person who is giving you money in terms of loan, okay, for him, a negative working capital is something which he doesn't really appreciate a lot. For him, he wants assets which can be easily sold and paid off for him to get his money back. So when you're looking from a lender's perspective, it is better for you to be having enough assets to support your current liabilities. Sorry. Alright, but when you're looking from operations activity, just imagine what a negative working capital means. What negative working capital means is that you do not have to really keep any inventory. Okay, you don't really have any receivables. Why you don't have any receivables? Because you don't sell anything on credit. Whatever you sell, you get cash instantly. So if you don't have receivables, you don't have inventory, but you are able to tell to your suppliers, ki, boss, I will pay you only after some time. Isn't that, from running a business point of view, it's a great situation to be in? Because you don't pay, you don't sell in credit, you just get cash the moment you sell it. You don't have to make any inventory buildup. You just go and buy and instantly whatever you need to make your product, you just get it from the market, you just make it. And to your suppliers, you say, okay, I'll pay you only after some time. So you build your cash in that sense also. So from a business running perspective, if you have this kind of a situation, which is called a negative working capital, this is a very ideal situation to be in. Alright? But when it comes from a lender's perspective, he will say, okay, you don't have any assets. How will I give you money? Right? Yes, as of now, I'm just assuming non-cash assets. Okay, Nish? So I get your point. I'll come to that part also. Alright, so in this case, when they say negative working capital, this essentially we talk about any business which is able to put its suppliers on the base saying, okay, I'll pay you after some time. But remember, whenever you're studying a company and you look at negative working capital, you look at together with a lot of other things. A negative working capital can also be because of the absolutely opposite situation of a particular business. So I'll give you another situation now. Imagine that you have some receivables, okay, but the person who is supposed to give you money, he has told you, okay, boss, I cannot pay you money. Okay, I will not pay you money. Okay, what I can or not. Okay, so in that case, your accountant tells you that since you are not going to get the money, you remove it from your balance sheet. It is no longer your asset. Okay, so you just take a write-off and you remove it from the balance sheet. So your receivables are low because you have to remove them, not because you don't sell in credit, but you sell in credit, but you're not going to get the money. Also imagine that you have no inventory because your inventory has gone useless. It happens in case of apparel companies. Apparel companies who have kept older inventory, their inventory is essentially useless because they're never going to sell that particular inventory at the same price at which they're carrying that particular inventory. And thirdly, you have a lot of people you have to pay money to, which are your suppliers, but you are not able to pay them. It's not that you are keeping them on bay, you're not able to pay them. Alright? So in that case also you can have a negative working capital. But that doesn't make it a very great position to be. So a negative working capital for a good business, a strong business, which have huge amount of assets, which have great amount of cash and everything else. From his perspective, negative working capital is a good thing to have. But for a bad business, if you see a negative working capital number in the balance sheet, what you are seeing is essentially not a great thing, but it could possibly be a trouble situation for the particular company. Is that okay what I'm saying here? Does it make sense putting in the context of working capital? Absolutely. Great. All right. So yeah. So now since we have done all these things, the only thing which is remaining is cash. Now I didn't use cash when I was calculating the working capital. All right. Can you repeat in one line? What should I repeat? The negative working capital thing? Okay, so what I'm just saying is that if you have a great business which has a good amount of cash, good amount of assets, making profits, and I'll tell you a few more ratios to look at later on. But if you have all the ratios are very good for this particular business, and it is a negative working capital business, well, great. I mean, in that scenario, it is a great thing to be. But if it's a very crappy business and all the things are not really good looking, the revenue is bad, there's no profit, your assets are not really great. If that is the case and you have looking at a negative working capital, just question that negative working capital. I'm not saying it is good or bad. I'm saying you should question it pretty hard. Okay, why it is negative. So that is the key idea here. Now, when I'm using this thing, I'm not using cash, but yes, cash should be used when you're calculating the current assets minus current liabilities. Okay, but generally we do not take all of the cash. We only take non-spare cash, the cash which I really have to keep in the business to keep it running. But again, these are two technical differences. You should ideally take cash into the calculations. That is not a problem. Okay. But imagine this. Okay, I'll give you a small example. Imagine Apple taking cash in the calculations of their working capital. Their working capital it will come out as a very huge number because they have more than $280 billion of cash on their balance sheet. Okay, but actually their working capital is negative. They don't pay off their suppliers. They sell not really too much on credit. Okay, and they pay off their suppliers very late. So they have a very good situation to be in. But still you will see a huge amount of positive number because of the extra cash which they have kept on their balance sheet. Okay, so when you're looking at the numbers, you have to put all these things into context. You cannot just have a straight away formula for anything in your life. Okay, especially in financial markets. Okay, so let's move forward now. Now I want you to sit and derive your cash number. When we started, we had cash of 5.65 lakhs. Okay, this year 15 lakh worth of revenue was there. Okay, but remember the last month 2,000 ice creams were sold on credit. So I haven't really received 15 lakh rupees in my revenues. What I have received is 15 minus those 2,000 worth of ice creams the price. All right. So 50,000 rupees of receivables are still left. So what I have received is 15 lakhs minus 0.5. Okay, minus 0.4. Why minus 0.4? Because my inventory, I have spent 40,000 rupees on building the inventory. Even though it doesn't go in my P&L account because I have not used this inventory to make my products, it is still a cash. I still have to take the money out of the vault to get this inventory built up, right? So this 40,000 rupees has gone into building of the inventory. What all things will come? My raw material expenses, remember it was 4.8, so that is going to come. 3.6 was my employee expenses. 1 was my miscellaneous expenses plus 0.8. So since I have got all these things, in my raw material of minus 4.8, I am assuming that I have paid all the money which I was supposed to pay to suppliers. But actually I didn't pay for 2 months of suppliers' money, right? So that is going to be added back to my cash flow because I've already subtracted total raw material expenses. Are you getting why I'm adding the number? It's not that I'm getting the cash, but I've already subtracted the total raw material cost, but I've not paid for the total raw material cost. I've only paid for 10 months of raw material expenses, not for last 2 months. Are you getting why I'm adding the 0.8? Just a quick, if somebody is not getting this right, no, otherwise it's fine. All right, great. So we added 0.8 for that perspective, and this minus 0.5 is the interest we have paid. Okay, so it is also going to go from cash. And minus 1.2 is the tax amount we calculated. Okay, so minus 1.2 of taxes, and this minus 1 is the debt which I have paid now for the, which is the loan repayment which I have done this time. Okay, so I have paid 1 lakh rupees of debt. Is there anything else remaining? Is there anything else remaining? Absolutely. Perfect, Shishir. So there is minus 1 of investments also. So 1 lakh rupees has gone through investments also. So my cash number is now going to be 7.45 lakhs. If I do this calculation, it comes to 7.45 lakhs. Alright. So my balance sheet application of funds sides look like this now. Is there anything else remaining? No, we have covered almost everything which was to be done. Now let's go to the sources of fund side. So this is my application of fund side. This is my sources of fund. On the sources of funds, look at what is happening here. The debt is 5 lakhs minus 1 lakh now, which is 4 lakhs. The owner's wealth is 5.05, which was the starting owner's wealth last year, plus the profits which I made this year of 2.8 lakhs. Alright, now even if you do not add the profits, you can derive the number just by balancing the two sides. Okay, so when you're making a balance sheet, again, it's not important for you to make a balance sheet, you get the balance sheets done, but you should understand the moving parts of this whole situation. So in this particular case, you could have derived the cash number without actually finding out all the things which we did, 15 minus minus 4.8, minus 3.6. You could have straight away derived that number. How? I know the profit. Sorry. So I know the profit number. This was there with me. This part I know. So my sources of fund I know already. This part I know already. These two are easy to calculate. This I know, this I know. The only thing which I have to really calculate along was the cash number. So if I know all the other parts, cash number can be easily derived because these two have to match. But I'm not doing it that way, I'm deriving it this way just to make you see that all the things will eventually, the moving parts of the complete financial statements in one go. Alright, so if you add the profits, eventually you will come up with the same number. Okay, now what I want you to do is, I want you to do the cash flow calculation yourself. It's pretty easy, we have done the whole thing